Hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. Very happy to have most of you with us today. So happy to see almost all of you here. As we explore the idea of adjusting for financial statements, very similar title to one of our previous chapters we talked about last week. Actually, the same title, it's a different, or I guess you could say it's a continuation of that discussion that we had last week on adjusting entries. We're going to go a little bit deeper this time around, but I want to first and foremost thank you all for being here. Very important to me, and hopefully very important to you that you're here. Let us first start, before we jump into the lecture, I do want to quickly talk about the classroom. We are in week 3 now. This is an 8-week course. As you all are very familiar with and very aware of, there is a lot of work going on in this classroom. There are about 4 action items for you to accomplish in every single week. There are 2 engage and explore components to work through, and then there's usually 2 quizzes. And that's where we are today. So last week, back in week 2, when we talked about adjusting entries and completing the accounting cycle, during that week, last week, so this past Sunday, you had annotations to complete and hypothesis. You had a LinkedIn Learning certificate on financial accounting for part 1. And then you also had the Chapter 3 quiz and the Chapter 4 quiz. So a lot of work. I know it's a lot of work. The reasons why we go through these exercises and go through these interactive learning components is not just for your interaction, although that's a big part of it. It's to give you that hands-on learning that really helps to facilitate the learning process, to help you to remember the accounting concepts that you're learning. And that's why we have you go through these engaging elements. And so if you have not completed these things, you are falling behind, and that's not good for this course. I still need you to complete all remaining work that you have not completed for this course. The reason for that is because if you fall too far behind, you'll run the risk of failing the course. Because next week we have the midterm exam, and that's when I have to report the midterm grades to the university to tell them how you're doing. Okay, and if it's unsatisfactory, meaning that you're not passing the course with at least a C or better at that time at the midterm exam, that's a problem. And so I have to tell your advisor about that, and I don't like to do that kind of thing, but that's one of the requirements for me as a faculty member here. So please, if you are behind, I need you to get caught up as quickly as you possibly can, because as we're now in week 3, for this week, under Engage and Explore, no surprise, but well, a little bit of a reprieve, I guess, is that there's only one thing to do for this week in the Engage and Explore, and that's another annotation through hypothesis. You'll notice it says 2 annotations and respond to 2 years, just like you did last week. And I thought last week was great. Most of you did it, and it was very active. I was thrilled to see the questions and the comments. So very similar to the way we did it last week. We have another video annotation to do in hypothesis. And then you'll have the Chapter 5 quiz and the Chapter 6 quiz. So that's what you have to do. So again, if you fell behind last week, I need you to get caught up immediately, and then complete these 3 things for this week. Because by the time we roll into week 4, which starts on the 11th of next week, by the time we start week 4, September 11th through the 17th, you'll notice the midterm exam. In addition to chapters 7 and 8, and guess what? Certificate. Busy week next week. So I can't have you fall behind. got to get caught up, because if you don't, you won't. It'll be very, very difficult for you to pass this course. So the midterm exam is not timed. It's a mix of multiple choice questions that covers chapters 1 through 8. But we'll have some time next week to do some review for the midterm exam. So just wanted to give you a little preview of what's to come. Questions before we start the chapter? We're doing okay.
No, sir.
Okay, great. Happy to hear that. Awesome. Thank you so much. Okay, let's go ahead and jump into it. Chapter 5. Did 4 last week. Chapter 5. Okay, so let's talk about completing the accounting cycle. This chapter is very, very similar to chapter 3 to some degree, because we learned about completing the accounting cycle in chapter 4. We talked about the adjusting entries in chapter 3. This is more of a continuation of that type of conversation, because as we discussed early on in this course, is that everything kind of builds on what you learned before. And that's very, very true, especially in this context of accounting. So we're going to talk more about analyzing and recording the transactions. We're also going to talk a lot about, in this chapter especially, because I really shouldn't call it adjusting for this chapter. This is really more of our inventory chapter. And we're going to talk a lot about inventory transactions. We're going to talk about purchasing inventory, selling inventory, related transactions. We'll also talk about how to value your inventory. And then we'll also cover a couple of ratios. So let's talk about service companies and retailers. And I want to talk about the differences between those two types of companies, because they report their revenue differently. Because as you might expect, with a service company, they're selling a service. An example of this would be an accountant, a lawyer, a plumber, a barber shop, a lawn care service. These are all service-oriented businesses, okay? Service-oriented businesses, they sell their time. They sell their service. It's not a tangible product that they're selling. They're selling the services. A hairstylist, the product is your hair, but it's not, like a physical product that you can do other things with, right? A lawn service, cut the lawn. Yeah, so that's a service. I mean, yeah, you could go physically touch your lawn, but it's not a product. It's a lawn service. Attorney, an accountant, a plumber, they're all service businesses. Right? So they're selling their time to earn revenue. What service represents. So the revenue that the service company collects is called service revenue. And so that's the account name. And so on their income statement, it's service revenue, the top line, sales. Service revenue minus all of their expenses, like rent expense, repairs and maintenance, utilities, wages, etc. equals net income. So revenue, sales, minus all of their expenses equals net income. That is what a service business income statement looks like. which is much different than a retailer. In a retail business, they sell physical products. Their physical products they sell to their customers through their store. Okay? Retailer, I think of Amazon, I think of Walmart, Target, Macy's, all of the big box stores, as they say. You can find anything at these stores, right? Literally, figuratively, pretty much everything. So, a merchandiser, or also known as a retailer, sells physical products to earn their revenue. That's where their sales come from. And so their revenue accounts are typically called merchandise sales. That's the name of their revenue account. Merchandise or merchandise sales is what it's typically called. So that's their sales. You'll notice the formula here. Okay. The formula says net sales. So here's what net sales means. Net sales is your merchandise sales minus any discounts, minus any returns. So it's your merchandise sales minus any discounts or returns, basically. So merchandise sales minus any discounts or returns equals net sales. That's where the word net sales comes from. Minus account called cost of goods sold. Cost of goods sold is exactly what the name implies. Cost of goods sold represents the cost it took the retailer, merchandiser, to sell that product to the customer. Okay. The way to think about cost of goods sold is the merchandiser, retailer, had to purchase the goods that they're selling. Okay. The merchandiser is like a middle person. Yeah? They receive their merchandise from their suppliers. And they sell it to customers. Here's an example. I'm a big fan of Macy's, okay? So I'm gonna talk a little bit about Macy's. Macy's, as you know, or as you may know, is a large big box retailer. They sell clothing, home goods, electronics, furniture, other homewares, jewelry, you name it, right? They sell a lot of different products. And so here's the example I'm going to give you. This is a real life example, okay? So the way retail businesses work is that they work with distributors. The distributors purchase the inventory from the manufacturers. Okay. Think of clothing for an example. So let's say you're wearing a t-shirt right now. I'm going to tell you how that t-shirt was made, how much you paid for it, how much Macy's paid for it, and how much the distributor paid for it. Okay, this is real life. Okay. So the way it works is in Bangladesh, where the majority of clothing is manufactured around the world, there are t-shirts being made for about 2 cents a piece. It takes about 2 cents to make a t-shirt. If you think I'm exaggerating, I promise you I'm not. Okay? About 2 cents. Sometimes 5 cents, depending on a couple of factors. Okay? That includes labor, by the way. Okay? So, 2 cents a t-shirt, we'll say. direct materials and direct labor. Maybe a little factory overhead. Okay, that's the cost of manufacturing a T-shirt. 2 cents, maybe 5 cents, depending. So let's keep it rounded. We'll say it's 5 cents. It takes 5 cents to manufacture a T-shirt in Bangladesh. So what happens is the distributor goes to Bangladesh to the manufacturer and says, "Hey, manufacturer, I would like to purchase, 100,000 red shirts, 5 cents each." Okay, so I'm just breaking out my calculator just for this purpose of this example. So 100,000 shirts.
Someone was detected at your
0.05 cents each is $5,000. It's not a lot of money, right? So 5 cents each. So it costs the manufacturer 5 cents to make each shirt. The manufacturer sells those shirts to the distributor for 7 cents each. Okay? So 7 cents, 0.07 times 100,000. $7,000. Okay, not bad.
Someone was detected at your front door.
$7,000
Someone was detected at your driveway.
is what the distributor purchased 100,000 red shirts from the manufacturer for. So it's made for 5 cents. They sell it to the distributor for 7 cents. Yeah, true story. The distributor then takes the goods from Bangladesh, loads it onto a shipping container, and ships it to the United States. Obviously, there's a lot of cost involved in shipping products overseas. So let's think about the cost to the distributor. 7 cents for the shirt, so 0.07, plus another 3 cents in shipping cost. Now we're at 10 cents. Okay, plus another 2 cents in labor, plus another 3 cents in overhead. We're at 15 cents a shirt. Okay, is the cost that the distributor had to get it from Bangladesh, where they purchased it for 7 cents, onto a shipping container, the United States, landed cost 15 cents per shirt. Remember the example, the distributor purchased 100,000 shirts. It's $15,000 ultimately that the distributor paid for those shirts. 7,000 was the purchase price from the manufacturer. The distributor then had to get it to the United States, process it. Okay. Now we're at 15,000. The total cost of 100,000 red shirts. So 15 cents a shirt is the distributor price. They sell those shirts to Macy's. That's the next step in the process. Macy's buys all the shirts and then they distribute to their stores. Guess how much they buy the red shirts for a piece? What do you think? Remember, it cost the distributor 15 cents a shirt. How much is Macy's paying for each shirt? What do you think? How much?
$10 or less, maybe.
Oh, way less. Way less.
Okay, that was too high. $3.
Way too high.
Wait, okay, it's still less than that. $1.
That might be high. It's probably less than $1. I would, if I had to guess, Macy's is actually paying for them red shirts, and we don't know. I don't work for Macy's, so I couldn't tell you. This would be considered inside information.
No.
But if I had to guess, because I know the rest of my prices are correct, it costs literally 5 cents to make a T-shirt. Okay, the threads and everything. The distributor bought it for 7 cents. It cost the distributor that plus all the shipping, so 15 cents all in. So they have to sell for more than 15 cents to make.
Okay, so maybe a quarter.
Probably around there. Yeah, it's probably around a quarter a piece is what they would sell it to Macy's for. Distributor's getting a good, decent profit on each shirt. Yeah? The middleman always gets the best profit. So they sell to Macy's for a quarter a piece. So 0.25 times the 100,000 shirts that Macy's bought from the distributor, that's 25 grand for 100,000 shirts. How much did you buy the red shirt from Macy's for?
That's when that's when it's cost. I don't know. They jumped the price up a bunch when you buy it.
I would say more than a bunch. You bought the red shirt from Macy's for $20.
Yeah, that's what I was thinking about.
It cost Macy's a quarter to buy it. So that's real life scenario. You know what? When you go to Macy's, and you go to my favorite department, the clearance rack. You go to the clearance rack at Macy's, and you're like, damn, how can they sell this for 90% off? They must be losing money, is what you're thinking, right?
Yeah.
No way. There's no way they gotta be losing money. 90% off, no way. Come on. The original sale price is, what do we say, $20, for example?
Yeah.
Original sale price, $20. They bought it for 25 cents.
Still making a profit at 9%.
They're making a killing even if they sold it at $1.
Yeah.
So that is the real economics of clothing. That is exactly how clothing manufacturing works. That is exactly the type of pricing structure that is used by retailers, especially here in the United States. So the next time that you go to buy a piece of clothing, just keep in mind that it costs less than $1 to make. Okay? So that'll make you think twice. Why is, and some of you might be asking, well, why, Dr. B, why is it so expensive to buy stuff that's made here in the United States? Because we actually take care of our employees. Okay? Our overhead's really high here because we take care of our people. That's my spiel. But that is the real numbers behind clothing. It is the highest markup out of anything on this planet. Yeah, we're talking about 900% markup. So yes, that is true. That is very true. The next largest markup, furniture. Yes, furniture. The majority of furniture sold in the United States is made in Vietnam. Okay? Vietnam's great at manufacturing furniture. They are excellent country at making furniture. Think of the couch that you're sitting on right now while you're listening to me talk. How much did it cost to make that couch? You bought it for $1,000 at the store, didn't you? But when you bought it for $1,000 at the store probably only paid maybe $200 for it. At best. The distributor sold it to the store for $100. Probably cost about $50 to make. Yeah. That's how it really works. So, in retailing, the whole reason why I'm telling you this long, awesome, very interesting story is because in retailing, when we look at cost of goods sold, that amount represents the cost to the retailer. So Macy's, in my example, They bought each red shirt for 15 cents. So 15 cents a shirt is their cost of goods sold. Understand? Net sales minus cost of goods sold equals gross profit. So Macy sells a shirt for $20, retail price, minus the 15 cents it cost them. I have to be a rocket scientist to figure this out. $19.85 is their gross profit from the sale of one red shirt.
We're only doing one shirt. We're not doing all 100,000.
We can do 100,000 if you want, just to make it fun.
Oh, no, it's okay. Do whatever you want.
So 100,000 red shirts. They purchased those red shirts at 15 cents a piece. It gives them a cost of 15,000. So 100,000. So 15,000. 15,000 is the cost. Let's say they sell all the red shirts at $20 a piece. Retail price, that's $2 million in net sales, minus the $15,000 in cost of goods sold, that's $1,985,000 of gross profit. Just on 100,000 red shirts. So minus the expenses. Okay, this is where it gets heavy, the expenses. In retail business, majority of their costs is in expenses. They have to pay their sales employees. They have to pay their management. They have to pay utilities, rent, and rent and retail is a big part of the expenses. In X, Y, and Z. So we whittle this $1,985,000 down by a lot. And so that leaves us with our net income. The net income is probably $100,000. So that's how it works. That's the quick and dirty on retail, on merchandising. Here we have, pardon me, on the bottom part of this slide is from Nordstrom, another big box retailer that's not doing so hot in 2023. Okay, but let's take a look at what's going on with them. So here we have the revenue, expenses, net income. Revenue was $3 billion. Their expenses were $2.6 billion, giving them a net income of $423 million. So let's look at let's break it down further. Net sales. Their net sales was $15 billion. Their cost of goods sold was $9.9 billion. Okay. That gives them a gross profit of $5.5 billion. But they're also very expense heavy at $5.1 billion in expenses. That leaves them a net income of $496 million. Now you're looking at this and you're saying, "Well, Dr. B, it's they got a lot of expenses. They got a lot of expenses." Yeah, that's the nature of retail. But this just kind of helps you to break down, really truly try to understand how retailers work. So let's look heavily at how inventory and merchandise works. Okay, so every retailer has what we call an operating cycle. The operating cycle represents the business cycle as a whole. So how does it start? It starts with cash. The retailer uses cash to purchase their inventory. Once the inventory is received, they sell that inventory to their customers, either on cash or accounts receivable, credit sales, yeah, as well as credit sales. When I sell a product to a customer on account receivable, we call that sold on credit sales. Okay. And then 30 days later or thereabouts, I collect cash from my customer. And then I do it all again. I sell the inventory, purchase more inventory, sell the inventory, purchase more inventory. It's a cycle, yeah? That's the nature of retail. That's how retail works. I'm sorry for the slide being so blurry. I'm just now seeing this myself. Very blurry site. Okay, so here's what it says, because I can barely see it myself. So I'll try to break this down for you. On the top left, it says net purchases. Net purchases represents all of the purchases of inventory that the company made during the month or during the year, depending on the period that you're looking at. Plus beginning balance of inventory, what I started that month with, that year with. It equals merchandise available for sale. All of my purchases plus what I started the month with equals merchandise available for sale. I have it all. It's ready to be sold. And then, of course, I'm going to sell the inventory. So when I sell that inventory, it becomes what we call cost of goods sold. It comes off of the balance sheet and onto the income statement as cost of goods sold. Plus ending inventory equals merchandise available for sale. And it follows a cycle. Okay. When it comes to inventory, there are two types of inventory systems that a company might follow. And it depends a lot on the type of business that the company is in. Okay? So here's how it works. The company can either use the perpetual inventory system or the periodic inventory system. The perpetual inventory system updates every inventory record based off of each sale that's made. Perpetual. The word perpetual means perpetual motion. Okay, continuous. Yeah, continuously updates. Perpetual. Perpetual means continuous. It updates the inventory when each sale is made. The best example I can give you of this type of system is the barcode. Okay, when you go to the checkout counter, you scan the little barcode on the ticket, right, on the label. The second that barcode is scanned, it automatically takes what it is that you're purchasing out of their inventory. It automatically updates. That's why the last time you went to Best Buy, you went on their website and it says in stock. It says they have 5 of them in stock. You go down there, guess what? There's 5 of them in stock. How is that? Because they use the perpetual inventory system. It updates every time they sell one. So when you buy one, then it says 4 in stock, right? Until they purchase more and bring it in. The perpetual inventory system automatically updates after each sale is made. Think of the barcode when you hear perpetual. Make the little beep noise. Boop, boop, perpetual. That's how I remember, perpetual. The other system is called periodic. This is where we update our records at the end of the accounting period. We do that through what we call a physical inventory. We go out and we count how many are on the shelf. We count how many are on the lot. Okay? And we do that once a month. Physical count. Type of business that would use a periodic inventory system would be like a really small retailer that only sells like a very few products, like maybe a corner store type of operation, Another type of operation that might do this would be like a food truck vendor or like a a small local business that only sells very few products. So they would probably use the periodic system. They might also use a barcode reader, and then they just do a physical count at the end of each month. So technically, they're using both. Another type of business that would use a periodic system would be a car dealership. They physically count how many cars are on the lot at the end of each month. So that's the best way to differentiate between the two systems. So let's look at some transactions that we would make using the perpetual inventory system. So our business in this example for the chapter, we are a small local retailer that sells mini mart type of goods and services. Yeah, we own the corner store. All right. So November 2nd, we purchased some inventory from our vendor, our distributor, using cash. So I debit merchandise inventory, $500. I credit cash, $500. My distributor brought me the products. I paid them cash. Simple transaction. Okay. So my inventory on the shelf, November 2nd. Sometimes my distributor might tell us, oh, hey, Dr. B, we'll give your corner store a discount. I love discounts. Discounts are great. I say, well, what kind of discount you want to give me? They say, hey, you know what? Since you buy so much from us, we'll put you on what we call credit terms. Okay, this is where the seller gives a discount to the buyer if they pay the bill early. Yeah. Okay. Oh, that's nice, right? So you might see this once in a while. Let's say you buy something on an account somewhere. They'll say, hey, you pay us early, we'll give you a discount. Cool. Yeah, that's called credit terms. Here's how it works. Credit terms is what we call the credit period, usually about a month. They send you the bill. The bill is called an invoice. It has an invoice date on it. That's the date that they sent the bill. And on the invoice, it'll say, hey, if you pay us in so many days, we'll give you a certain percentage discount. Otherwise, the whole thing is due at the end of the credit period or the due date on the invoice. These are what we call credit terms. So discount period is the amount of time that you have, the number of days you have to pay in order to receive the discount. There's usually a percentage. Otherwise, you owe the whole thing at the end of the period. Here's a term that I want you to understand. It looks kind of funny, right? It's like, oh, what the heck is this? Never seen anything like this. This is the credit terms in a very simple way, and this is how it would show up on your invoice. It'll say 2 over 10, comma, n over 30 is what it means. If you pay this invoice within the first 10 days of the invoice date, you will receive a 2% discount. Otherwise, the entire invoice is due within 30 days. See? 210 net 30. 2% discount if you pay within 10 days. Otherwise, the net, or all of it, is due within 30 days. Now, this is just an example of the types of terms. I've seen other kinds of terms where it's like 5% discount the first 15 days. Otherwise, the whole thing's due within 30 or 45 days. It all depends on the terms, is what I'm saying. But it's important that you know how to read this part because you'll see this at some point, either on a quiz, on an exam, or even in the future. You'll see it at some point. Here's an example of an invoice. This is what a typical invoice looks like. It has seller information, number one, who's selling the stuff. Number two, the date, the invoice number. Number three, who it's being sold to, the purchaser. Yeah. Number four has the purchase order date. That's an important date to know. When the purchase order went out. Invoice date, obviously the most important date, 11/2 in this example. Number five are the terms. In this example, it's 2% discount if I pay within the first 10 days. Otherwise, the whole thing's due within 30 days. Number six, this one is also important to know. How it is being shipped. Not the FedEx part. I don't care about that part. I care about the part that says freight. This says free onboard destination. Here's why that's important. Free onboard destination tells us who is responsible for the goods while they are in transit. In other words, something goes wrong, who's going to cover that cost? Is it going to be the buyer or the seller? Okay. It depends on the freight. Free onboard destination usually means the seller is responsible until it reaches the destination. Okay? If it said free onboard origin, that usually means the buyer's responsible for the shipping. Okay? That's why the terms are always important on these things. Number 7 lists out the products being purchased, the quantity, the price of each product, and then the total amounts. And then, of course, if there's any shipping charges or taxes, whatever. And then, of course, the total amount. And then you'll see in the lighter print toward the bottom, it says net of discount, $4.90. What that means is if I pay within the first 10 days, I'll pay $490, not $500, because I'm getting that 2% discount. $490 is obviously minus the 2%. Okay, so let's say we made the purchase on credit from our vendor, and the vendor says, "Hey, pay me within the first 10 days, I'll give you 2% discount. Otherwise, the whole thing's due within 30 days." And I said, "Well, that's a great idea." So I purchase the inventory. I debit merchandise inventory, and I credit accounts payable. Because it's a bill, I got it from my vendor, got to pay my vendor back. So let's say I'm like, yeah, I will be happy to pay this bill right away to take care of getting that discount. So same day, I'm like, you know what? Don't go anywhere. I'll give you the discount right now. I'll give you the cash right now. So I debit accounts payable. I credit. I debit accounts payable $500 because that's the total bill. I credit cash $490. I could already hear you, Dr. B, debits have to equal credits. I know. So then we credit this other account called merchandise inventory. As you know, merchandise inventory represents the total purchase price for inventory. You credit it, you're reducing it. So I would reduce the value of that inventory by $10 because I have a $10 discount. You have it when you're discounting inventory, you're reducing the value of that inventory. So that's why you see the credit for $10. Questions? Makes sense so far, yeah?
Yeah,
Okay. All right, we're getting there.
I struggle with this chapter, so I'm being quiet for most of the class.
Yeah, no worries. I totally understand. Yeah, just let me know, whenever you're like, oh, this is the part I didn't get. I'll help you walk through. Well, I'll walk you through it.
Right.
Cool. Okay, so we made the purchase. We got the discount. We paid $4.90 in cash. We reduced our inventory by $10 value because of the discount. What does it look like on the T accounts? So on our T accounts, we see the date I purchased it, November 2nd, the day I paid it, November 12th. The inventory, I reduced the inventory by 10. The date that I paid it to represent the discount. I paid cash, $4.90. Let's say, a month went by, and I was like, oh, I missed the discount. You still got to pay, still got to pay the total amount. So debit accounts payable, credit cash, the whole 500. Now, this part can be a little confusing, and this is called purchases, allowances and returns. Yeah, is oftentimes what it's called, allowances and returns. Allowances and returns. This happens. Actually, this happened to me recently. I'm working on a project right now, and some of the stuff that I ordered for this project was defective, so I had to send it back. I was like, well, I can't use it. It's broken. When I got it, so I'm like, well, I'm going to send it back. So I'm just went through what's called a purchase allowance. Well, it's really a return because they're going to send me a new one. Here's how it works. Let's say you purchase something and it's somewhat broken. It doesn't work the way it's supposed to. It's defective. So you call up the person you bought it from. Say, hey, you sent me some broken stuff here. So they might say, and I've seen this happen, they might say, hey, keep it. We'll give you a discount on your next order, or we'll give you some money, a little bit of money back for the broken stuff, and the rest of the stuff you keep. Okay, it's called a purchase allowance when that happens. The other thing that might happen is called a purchase return. It came in broken. I'm sending it back to you. Okay, that's a return when you send it back. Yeah, or it came, or oh, that's not my size. It's the wrong size. Send it back. Send me the right size. It's called a purchase return. So here we have an example. Our company, we bought some product from our vendor earlier. You remember, we bought $500 worth. So here we are a couple days later, and we noticed, hey, we got a problem here. Some of the stuff don't work. It's broken. So we call up our vendor and we say, hey, we got some broken stuff here that you sent us. Okay, so they'll say, all right, we'll give you a discount on the broken stuff we sent you. Okay, no problem. So we debit accounts payable $30 to represent the amount of the defective product that was sent to us. In other words, we're subtracting that $30 from our total bill. We haven't paid them yet. Yeah. And we're going to credit merchandise inventory $30 because there's $30 worth of damaged stuff. Can't sell it, so take it out of inventory. So that's what this transaction represents. Continuing the theme, our company purchased $250 worth of merchandise on June 1st with credit terms 2% discount if we pay within the first 10 days. Otherwise, the whole bill is due within 60 days. That's nice. June 3rd, we realized, hey, we got some broken stuff here. We got $50 worth of broken goods. We need to send this back. Or we just say, oh, we bought too much, we'll send some back, whatever. So we send $50 worth of goods back to our vendor on June 3rd. On June 11th, I decide, hey, let's take advantage of that 2% discount on the remaining $200 balance. You'll notice I returned $50 worth of stuff. That means I have $200 worth of stuff that I kept. And they gave me a 2% discount in the first 10 days. That discount gets taken on stuff you have left. Yeah? So, here are the transactions I'm going to make. June 1, I purchased the inventory. Debit merchandise inventory $250. Credit accounts payable $250. Now in the notes we put the term. On June 3rd, that's when we noticed the defective goods and sent it back. Debit accounts payable $50. Credit merchandise inventory $50 to represent the $50 worth of stuff we're sending back. 11th, paying the bill. Debit accounts payable $200. Credit cash $196. Why $196? Because 200 times 2% is $4. Okay? So, credit cash $196, because that's how much cash I paid. I credit merchandise inventory $4 to reduce the value of my inventory by $4. Make sense?
Yeah, this is the type of problem I would have. While I was trying to figure stuff out. I went ahead, and so this is the type of problem I'd struggle with.
Sure.
Even looking at the PowerPoints and looking at the stuff, it's different when you have someone telling you or making you understand what you're looking at.
Yeah, I appreciate you saying that, Leland.
Eventually, it's like it just looks like a bunch of numbers when you're just looking at a bunch of stuff enough time. You start just racking your brain trying to figure it all out. So this is helpful.
Thank you. Yeah, I try to tell the story. That's the thing. That's the thing that people don't like about accounting is that, it's boring. Is that the reason why people think it's boring is because they think it's just numbers. That's what I used to think. I used to think, oh, accounting's boring. It's just numbers, I'm like, numbers are boring. But then you get the fun part behind the numbers. You hear the story. When you hear the story, it begins to make sense. Yeah, I appreciate you saying that. All right, cool. Earlier I told you about the shipping situation. So it's all about who's responsible for the goods while they're in transit. So, as I had mentioned, free on board destination What that simply means is that the ownership is transferred at the destination point, usually the buyer's location. And that also means that the seller is ultimately responsible for the shipping. They have to pay the shipping cost, and they're also responsible for the insurance while it's in transit. So for free onboard destination, the shipping cost is paid by the seller, and it looks like this. They debit delivery expense. It's just an expense. Shipping expense. And they credit cash. But what about when it's free onboard shipping point? Shipping point means that the buyer is responsible for the shipping from the shipping point to the destination. So the buyer is responsible for the insurance of the products and for paying the expense of the shipping. But here's how this works. Earlier I gave you the story about Macy's. I mentioned, very specifically that the distributor ended up having to pay 15 cents, right, was their total cost for one shirt. How we got there? Because they bought it for $7. Remember, there's a couple of cents that they had to add in for the cost of getting it from the manufacturer to the United States for processing. Okay, a lot of that had to do with shipping cost. So, what the distributor would have done is they would debit merchandise inventory to add to the cost of inventory to include shipping. You see? That's how that works. So, free onboard shipping point, the buyer's responsible. The buyer increases the overall value of the inventory by the cost of the shipping, and they credit cash to pay the shipping company. Here we have an example. Our company purchased some merchandise, free onboard shipping point. That means we have to pay the transportation charge. So we debit merchandise inventory $75, the shipping charge. That increases our overall value of our inventory by $75. And credit cash to pay the shipping company. You see? If we look at this as in a closer example, looking at itemized costs, here we have an example. Invoice cost of merchandise purchases. This is the company purchasing inventory from our vendors. We purchased $235,800 worth of inventory. We received discounts because we paid early. So minus $4,200 in discounts. We also had a situation where we had to send some stuff back. It wasn't good, it was defective, didn't fit right, whatever. Minus $1,500 for returns and allowances. We had to pay free onboard shipping point, transportation expenses, $2,300. So we add that part in. This equals the total cost of merchandise purchases, $232,400. So the formula here is purchase price minus discounts minus returns and allowances plus shipping equals net cost of merchandise purchases. Sense?
Yeah, makes sense. Makes sense.
Awesome. Cool. Thank you. So yeah, we just looked at really understanding how retail businesses work. We looked at the concept behind inventory, how inventory purchases work. Let's take a look a little bit deeper at a couple of other components here. So let's take a look at some transactions for sales using the perpetual inventory system. Remember, the perpetual inventory system, that's the barcode machine, yeah? Perpetual means continuous, continuously updates. We talked about purchases, now let's look at sales. So I'm selling to my customers. One of the biggest things to compute, of course, is gross profit. And you know how to do this. This is an easy formula. Take your net sales, which is net of discounts, returns, and allowances, minus cost of goods sold equals gross profit. Why is gross profit important to understand? Is because gross profit tells us the potential of the company to generate a profit. The company sells merchandise. There's two things that are happening here. Okay, there's really two transactions that occur every time I sell a product. Of course, they happen very quickly, automatically, really. There's two things that happen. One is a transaction representing the sale itself. And the second transaction represents the reduction of inventory. You have to take it out of inventory to sell it. Yeah, but the two things happen at the same exact time. First is we recognize the sale. Second is we recognize the reduction of inventory. That's what it looks like. Here we have an example. I sold $1,000 of inventory on credit. Okay. $1,000 represents the sale price, not how much it costs. Remember, we always sell for more than what we bought it for. You never, ever pay below what you, or sell it before what you bought it for. Otherwise you lose money. And we don't go into business to lose money. Okay, so here's the transaction. I sold it to my customer, $1,000 on credit. It cost me $300. Debit accounts receivable, $1,000. I sold it on credit to my customer. They're going to pay me later. Okay, that's accounts receivable, $1,000. I credit sales, $1,000. The other thing that happens at the same exact time to take it out of inventory is I debit cost of goods sold, $300. I credit merchandise inventory, $300. The two things happen at the same exact time. Because remember, every time you sell something, there's two transactions that need to be recorded. You record the sale, and you record taking the product out of inventory. We talked about this part earlier. Discounts. Every time there's a discount involved, there's what we call credit terms. Customer pays us within a certain amount of time, we give them a discount. Otherwise, the whole thing is due later, at the end of the invoice period. Okay? Just like before. So here, we sold $1,000 worth of stuff to our customer account. They're going to pay us later. That's what happened on November 12th. The terms are, we told our customer, we said, hey customer, You pay me within the first 10 days, I'll give you a 2% discount. Otherwise, the whole thing's due in 45 days. So, November 22nd, 10 days later, customer says, great, we'll take advantage of that discount you offered us. Awesome, cool, sounds good. We debit cash $980. Why? Because we gave our customer a 2% discount on a $1,000 bill. 2% of $1,000 is $20. So the sales discount is $20. So we debit a new account called sales discounts, $20. And then we credit accounts receivable, $1,000. Let's say they don't pay us within the first 10 days. Well, that's simple. They'll pay us later. So when they pay us, we just simply debit cash $1,000, credit accounts receivable $1,000. Straightforward. Returns and allowances. It's very similar with our customers. Customers ain't always going to be happy. You're never going to make everyone happy. That's just life. Okay, it's impossible to make everyone happy. It is. Okay, I try to make my students happy, but sometimes they ain't happy with me. That's life. So, returns and allowances. Just like before, people are not satisfied. We weren't satisfied with our vendor when they sent us broken stuff. Now we got customers not happy with us because of broken stuff. Okay. Sales return is when the customer brings the merchandise back to us after we sold it to them. For whatever reason. It doesn't fit. It doesn't look good on me. It don't work. It's broken. Bring it back. Sales return. The alternative is a sales allowance. This is when we give them a reduction in the sales price. Okay. In other words, they bought a bunch of stuff. Some of it don't work. They're going to return. They're going to say, "Hey, some of the stuff you sold me doesn't work. Most of it's fine. Just a few of them don't work. We'll give you a sales allowance, reduction in the sale price, to make them happy." These are the two things that could happen with our customers. Let's go through the examples. Customer purchased something from us for $15. It cost us $9. Okay, they bought it from us for $15. They're bringing some inventory back to us. It's in good shape. I can resell it. It's not defective. No problem. So, the customer, hey, no problem. I debit sales, returns, and allowances, $15. And I credit cash, $15. And then, because the inventory is still good, I can resell it. I debit merchandise inventory, $9. Credit cost of goods sold, $9. Just puts it back in inventory. It's kind of like reversing it, basically. Let's assume we had a customer that bought some stuff from us. It was defective. Uh-oh. The buyer decided to keep it. No problem. But hey, because sometimes when things are defective, you try to return it. They say, "Hey, just keep it. We'll send you something else, or we'll give you a discount." Whatever. It's cool. Sometimes it's cheaper to do that. We debit sales, returns, and allowances, $10. Credit accounts receivable, $10. Reduce their bill by $10. So of course, as things happen, You have to make adjusting entries at the end of the accounting cycle, as you know, for these types of things. So we prepare adjusting entries to close out our temporary accounts and to end the accounting cycle before we post to our financial statements. At the end of each accounting cycle, we go through the accounting cycle, follow the flow of the merchandise. As we talked about earlier, we purchase from our suppliers plus beginning inventory balance, we started the month with, equals merchandise available for sale. When we sell the merchandise, it becomes cost of goods sold, ends up on the income statement. Anything left over becomes ending inventory, and it stays on the balance sheet. That ending inventory becomes the beginning inventory for the next month. You see? Moving one to the next. In the second month, made more purchases plus the beginning inventory equals merchandise available for sale. Whatever I sell becomes cost of goods sold, ends up on the income statement. Remaining balance becomes ending inventory. It stays on the balance sheet. That goes to next month. You see? A continuous. Some of the adjusting entries I might make has to do with lost merchandise. We lose merchandise for a couple different reasons. One reason could be I misplaced it. It happens. Another could be somebody stole it. You know, the life happens, yeah? So we have to account for what we call shrinkage, which is the loss of merchandise for whatever reason. So we did a physical count of inventory at the end of the year, as we always do, to verify what we have in our accounting system matches what's on our store shelves. And so we make adjusting entries for any type of loss. We debit cost of goods sold. We credit merchandise inventory to adjust for any kind of loss. Of course, when we do this, there is some expectation and consideration for what we call sales discounts, returns, and allowances that we also have to adjust for. We talked about what those looked like before, but sometimes we also estimate these things and we have to make adjustments. At the end of the year, or end of the accounting period, we close out all of our temporary accounts. We post them to income summary on our income, and then income summary is posted to owner's capital minus owner's withdrawals. This is the closing process. It's just like any other closing process, follows the same exact procedures. Here's a nice summary sheet. I like this slide because it just helps you to summarize, the different types of transactions that occur for purchases of merchandise and for sales of merchandise. Just a nice little summary. Here's a nice summary for adjusting entries and closing entries. Great slides, aren't they? You can look at those when you're, taking your quiz or your exam or whatever. It's just a nice reference. And then one of the last things we do in the accounting cycle, and we talked about this in the previous chapter, is to prepare our financial statements. This is what a financial statement would look like for a retailer. This is called the multi-step income statement. The format's just a little different is all, okay? And the way it works is at the top, we have our sales, minus our discounts, minus our sales returns and allowances, equals our net sales, minus cost of goods sold, equals gross profit. Below that, we have all of our operating expenses listed out. Selling and general administrative expenses, other expenses, total operating expenses. So we take our gross profit minus our total operating expenses to equal income from operations. And minus all of our other stuff, like interest and expenses, blah, 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 to equal income. But we call this a multi-step income statement because there's multiple steps. It's all broken out. You see, this is the most detailed version of an income statement that you'll ever see. Here we have the same income statement, but only in what we call a single step income statement. It's very condensed, as you can see here. You'll notice a key difference. Here it is. For sales, your revenues, we have net sales plus interest revenue, which is other revenue, plus any other income equals total revenue. So that's a little different because before we saw interest revenue at the bottom on the multi-step. The other difference is cost of goods sold and gross profit. You don't see gross profit on here. We have cost of goods sold listed as an expense. And then we group selling and general administrative expenses. We get total expenses. Total revenue minus total expenses equals net income. Single step. Just condensing everything. That's really the biggest differences. Of course, you've already seen this, the balance sheet. As we talked about earlier on, and I think I mentioned this maybe in the first or second lecture. It had to have been the second lecture. Yeah. On that Thursday of the first week of class, I'd mentioned that the balance sheet is listed out by the order of liquidity. How liquid things are. Cash, highly liquid. Accounts receivable, I could quickly convert to cash. Inventory, not as quick, but getting there. And then it slows down. It's hard to sell buildings and stuff. But the classified balance sheet, as you know, separates things into current and long-term. Current and long-term. So current assets, long-term or long-lived assets, or also known as fixed assets. Then on the liability side, you got current liabilities, long-term liabilities. Yeah. Then, of course, the equity. And of course, a couple of ratios. These ratios help us to quickly compute things, gives us an idea of how functional the business is based off of their ability to quickly convert things into cash. It's called the acid test ratio. How quickly I can convert things into cash. 1 or higher is good. Anything below 1, we got problems. Acid test ratio, we take what we call quick assets, quickly convert to cash, divided by current liabilities. The quick assets are cash plus short-term investments plus receivables. Those are the quickest things I can convert to cash. Add those all together, divide by current liabilities, that gives me the acid test ratio. Here's an example, acid test ratio, as I mentioned, anything above 1 is good. So Nike and Under Armour, they're okay. No, they'll be fine. Under Armour had a problem a year ago. It looks like they got out of that. And one of the last ones, ratios I want to mention today is the gross margin ratio. So important. This tells me how well I'm covering all of my expenses in order to generate a profit. That's the best way I can explain it. So we take sales, net sales minus cost of goods sold divided by net sales. That gives me the gross profit margin ratio. So that was all the perpetual inventory system. This just kind of reviews like all of those transactions that we made, lists them out in a logical way, and it compares to what it would look like in a periodic system. So on the right-hand side is what all of the examples we worked through. On the left-hand side is what it would look like in a periodic inventory system. We're not going to jump too deep into that, but I just wanted to help you to understand the differences between the two systems. Just a closer look. The perpetual versus the periodic inventory systems. How it would look like in the closing entries. Not terribly important, but it's important enough that you have an understanding of the difference between perpetual and periodic. Here's a couple more examples of looking at adjustments for discounts, returns, and allowances. And it's just like ones that we worked through earlier to show you how sales discounts work. So debit sales discount, credit allowance for sales discount. This would represent an adjustment. Expected sales discounts. Sometimes you'll notice that we estimate expected discounts or expected allowances. And so to do that, we go through an estimation process. So it's important that you know what that is, because we'll talk about that again soon. But I just wanted to kind of give you a heads up. That's something that we do. Here's another example of an adjustment that we would make. This one is return and allowances and refund. This one's a refund payable. It works very similar to like an accounts payable. This one is inventory returns that we've estimated that might happen. Again, it's an estimate. And then this again shows us the comparison between the methods and for recording these types of discounts and adjustments. Nothing terribly exciting. I want to make sure we spend as much time as we did on the important stuff, yeah? So that, my friends, is the end of this chapter 5. We're going to jump into chapter 6 here in a few minutes. Let me stop the recording here and see what other questions we might have. So hold on just a sec.